Hello and welcome to part 1 of how to be a tax-efficient property investor. In this video, I'm going to show you how to use leverage and follow what the professionals do to be tax efficient in the 3 main UK taxes. So we want to be income tax efficient, capital gains tax efficient, and inheritance tax efficient. So we'll start with how to be income tax efficient. So in the example, we have a £100,000 property, believe it or not these prices are still possible in the north, with a £75,000 mortgage on interest only at 4.5%. We have rent at a level of £675, our mortgage monthly cost at £281, our maintenance costs, buildings insurance and our letting agent fee, which is generally about 12% of the rental income. So our net monthly income is £213 per calendar month. Now with income tax, if you're a lower rate taxpayer, you pay the basic rate of 20%. If you're a higher rate taxpayer, you pay 40%. By the way, the threshold for the bracket in this current 2022-2023 year is earnings between £50,271 and £150,000. For those who earn over £150,000, the income tax rate increases to 45%. Now let's consider debt for a moment. Now you may have been brought up, as many of us were, to believe that debt is bad. That's the mindset of a saver, not an investor. An investor understands that there is good debt and bad debt. A bad debt is something you have to pay whether you use something constantly or not. For instance, your mortgage, your rent, a car loan, etc. A good debt, however, is a debt that somebody else pays for and a debt which also makes you money. In property, we can leverage our money to make it go further and at the same time maximise our returns by mortgaging our investment properties. Just on a side note, I cover this in more detail in a separate video on cash purchase versus mortgage purchase if you want to watch it. A mortgage on an investment property is a good debt. It's paid for out of the rental income received from your tenants and also makes you money, as in our example when we're making £213 cash flow per calendar month. Many people with a saver mindset have been brought up to always pay their debts down. So let's consider for a moment 2 different property investors who we'll name Adam and Ben. Adam and Ben are both high rate taxpayers and each own an investment property worth £100,000. The key difference, however, in relation to how they invest is that Adam has leveraged his money and his returns on his investment property by a mortgage, whilst Ben has saved up and used his hard-earned cash to pay off his mortgage. But as you can see in our example, having paid off the mortgage, Ben's net monthly income has now increased as he no longer has that mortgage debt. So now the government come along and say, OK Ben, so you've earned an extra £281 a month. That's £3,372 over the year. So we'll charge income tax on that extra income. So whilst Ben has worked really hard to pay his mortgage down, his reward? A higher income tax bill, costing Ben in this example an extra £1,350 a year in income tax. So you can see that we don't want to pay the mortgage down. Don't take out a repayment mortgage, as that is paying the mortgage down. To be income tax efficient, you need to take out interest-only mortgages on your investment properties. Adam, on the other hand, has kept his mortgage and increased his rent every year. It's important to always put your rent up every year by 3 to 5%, and we'll come on to the reason for this later. Adam's original rental income of £675 has become £737 within 3 years, which now adds an extra £62 onto his monthly income, putting him at risk of paying more income tax. However, over those 3 years, there will also have been some inflation. And so the cost of maintenance will also have gone up to say £90. His letting agent fee has also increased to £88 due to the increased rent, but the value of his property will also have gone up in that time. So Adam goes back to the bank, tells them that his house has gone up in value and asks to borrow 75% of the new value. The bank want to make sure that the level of rental income is sufficient to meet their criteria, but Adam is able to confirm that he's been increasing the rent each year. The increased rental income passes the bank's rental stress test, and the bank agreed to lend on the new value. This means a higher monthly mortgage payment, but again, as Adam has increased his rent each year, that increased rent will cover the increased cost of the new mortgage. So with increased rental income, but an increase in mortgage cost to $325, plus increases in some other costs due to inflation, Adam's overall net monthly income remains basically the same. Let's move on to how to be capital gains tax efficient. House prices on average double approximately every 10 years, but let's model on a 15-year period just to be more conservative. So 15 years from now, a £100,000 investment property would be worth £200,000, and 15 years on from that, it's worth £400,000. So let's consider two scenarios. Scenario 1, if the property is mortgage free and the investor then decides to sell the property, they'd have a £300,000 capital gain, so they've now triggered a capital gains tax liability, which at a rate of 28% tax results in a hefty bill of £84,000. However, in our second scenario, our investor doesn't sell but opts instead to raise finance to 75% of the value, releasing a sum of £300,000, which is tax-free by the way as it's borrowed money, into their bank account. So whilst both scenarios raise a sum of £300,000, the second scenario doesn't trigger a capital gains tax liability and the investor still owns the property. And why is that important? Because the investor can continue to benefit from further increases in value. I'll cover this more in my part 2 video, how to take your profits tax efficiently. And yet another important fact to consider, some of you may have heard of something called capital gains tax washout. Basically, if you die while still owning investment property and you've made a capital gain, then on your death, the capital gains tax gets written off. If you sell your investment property even one day before you die, then the liability for capital gains tax is triggered. If you die first, there is no capital gains tax to pay, so why would you sell? This highlights a key principle: never ever sell an investment property. The only caveat to this is that you've bought good investment properties that will rent out well. If you've bought poor properties in poor areas, then please have a specialist look over your portfolio. It may be that it's still better to keep them for the tax benefits, or it may be that you do sell those ones off and replace them with investment properties bought with careful due diligence. So we've looked at how to become income tax and capital gains tax efficient. Let's look now at our final area in this video, how to be inheritance tax efficient. The inheritance tax threshold for an individual in the current year is $325,000. That means that when you die, if the value of your estate is up to $325,000, you can pass this on tax-free. So let's go back to the case of Ben from earlier. We will assume that Ben now owns a £1 million portfolio with no debt. And also for the purpose of this scenario, I'm going to assume that the value of Ben's own residential home and other assets and savings uses up his full $325,000 threshold. The executors now are liable to pay Ben's tax liabilities out of his estate, which at a rate of 40% on his £1 million portfolio means an inheritance tax bill of £400,000. That tax bill also has to be paid within 6 months of the date of Ben's passing, otherwise HMRC will begin to charge interest. Now, no one can generally predict when they're going to die, so in Ben's case, if he had died in a flat or falling market, then his executors would need to sell off the property portfolio quickly to pay off his tax bill. So in a flat or falling market, it's likely that the executors would accept lower offers, perhaps even 15 to 20% less for a quick sale. So whilst Ben has spent his whole life working hard and building up this great portfolio for his kids, It's then sold at a reduced price of £800,000 for a quick sale. Not only that, but once the inheritance tax bill of £400,000 is paid, then only £400,000 of his £1 million estate remains, less than half of what it was worth. Adam, on the other hand, didn't pay his mortgages down and kept refinancing as his properties increased in value. He therefore has a £1 million portfolio also, but with £750,000 of debt on it. Now that level of debt is not a problem for Adam, as it's a good debt. In other words, someone else is paying for it and it's making him money at the same time. When Adam passes away, the 40% inheritance tax charge is still triggered, but applies only to the equity in his portfolio of £250,000. So his inheritance tax bill is only £100,000, not £400,000. Which option would you prefer in the event of your death? So we've covered a few key principles to follow to ensure that your property portfolio is tax efficient. Number 1, leverage your money with an interest-only mortgage. Number 2, make sure you increase your rent by 3 to 5% every year. Number 3, as your property price rises, increase the good debt against it. And number 4, never ever sell your investment property. To find out how professionals take their profits from property tax efficiently, please watch part 2 in this series.